Hello and welcome to TradingFloor.com's weekly market overview. It is a crucial time for the US economy and its recovery. With only 2% GDP growth reported, we await the FOMC meeting, payroll reports and the midterm elections, and we also have other major central banks about to meet. The US businesses that need to drive economic growth are currently hit with more uncertainty. And to give us a roundup and insights into these events, we have with us Koefoed, macro strategist at Saxo Bank. Welcome again, Mas.
Thank
you. So if we have a look at what we've got coming up, what's our current status of the US economy right now in terms of what's just happened with GDP?
Well, obviously, if you look at the raw numbers, then we saw a slight increase in activity in the third quarter compared to the second, because we saw 2% growth versus 1.7 in the second quarter. But if you look beneath the headline numbers, then it was once again inventories that drove this increase in GDP, and also government spending was again quite solid. So actually, if you remove those two components, we actually had a completely flat GDP. And what is traditionally called final sales, that is actually GDP less inventories, rose 0.6% only on an annualized basis. So we practically have zero growth at all in sales, contributing to US growth. So we're not actually improving, and the minute that this inventory cycle slows down even more, then we don't expect a significant uptick in growth from other areas. So we expect growth to decline even more in the fourth quarter and in 2011. It's going to be some weak quarters ahead.
And so we've got some up and coming announcements, being the FOMC and the Non Farm Payrolls. What are we expected to see for the US?
Well, it's an extremely busy week, not just for the US, but also from other central banks around the world. But of course, the US is the main focus, because we have the elections and the FOMC meeting and non-farm payrolls. And if you look at the FOMC meeting, then we look at a smaller quantitative easing program than we were looking for in September. And that's because we've seen quite a number of solid numbers in October, especially the ISM manufacturing number out yesterday, and also a wide range of numbers before that. So a lot of numbers that were better than expected, and perhaps signals to the FOMC that they shouldn't make as vast a program as earlier priced in. We have to remember that in early October, the market was pricing in QE of around 1 trillion, and now it looks like we would probably get half that. Probably some announcement tomorrow that they'll do some 500 billion injection over the next half year or so. That's what we're looking for right now.
And would that drive the dollar down further? Do you think that would achieve their goals?
Well, actually, I'm quite unsure what their goals are, because I don't expect QE2 to work at all. We talked about that before, and I maintain that stance. I don't think the QE is going to do anything else but be additional reserves on the bank's balance sheets, and they're not going into the economy because banks are very reluctant to lend them out, and consumers don't want to get more debt, pile into more debt. So I'm not quite sure why they're pursuing this second round of quantitative easing, because clearly the first one didn't work. I think we need to look at some other tools to solve this problem.
So obviously one of the key cures, if you want to call it that, is jobs, and we've got the payrolls data coming up. What are we expected to see? Are we looking at any point in time more employment out there? Are companies looking for more people?
Well, I think we're going to get pretty much the same report as we've gotten the last couple of times, with private employment rising from around in the range of 50 to 100,000. We're actually looking for right smack in the middle of that, 75,000 private jobs. And then overall payrolls up a bit less, due to the fact that state and local governments are firing people on average, or on net. So we're looking for another number in around the 50,000 mark, and it's just a very weak increase in growth that we are looking at, and we expect that to continue. And we have to remember that this is the first time in many, many months where we can actually look at the overall payroll figure, because the census, 2010 census, that has interfered with the numbers for since January of 2010 is now practically over. They're only missing a few thousand people to fire. So now we can look at the headline payrolls number again, and we expect it to show around 50,000 additional jobs.
And to finish up, I mean, if we have a look at the global economy, we're seeing, countries like Germany, Brazil, and Australia, well into recovery. With the US, I mean, are we looking at potentially still a double dip with them? Is there chances for that happening for the US economy?
Yeah, I definitely still think there is a possibility. Obviously, right now there's a feel-good or a good feeling in the markets because we've seen these good numbers recently, and especially, as I said, the ISM yesterday was much better than expected by consensus and us as well. So we've had a string of good numbers, but the problem is that it's more due to the fact that the way growth has been driven in the GDP report is due to inventories that we talked about, and then the government spending. And while government spending could, to some extent, carry on, they're not exactly doing some austerity measures in the US just yet. But the inventory cycle will come to an end at some point. And if you think about it, perhaps even this additional step out in inventory restocking that we saw in the third quarter could end up hurting the fourth quarter and the first quarter in terms of their additional or their addition to inventories. So this cycle is coming to an end unless consumers pick up, and they're not going to do that. So yes, there's definitely a probability that we'll see a double dip. It will not be a crash like in 2008, because we already have a lot of the economy operating at very low levels, but we could dip just into negative territory for a quarter or two. Definitely, that's still a risk.
Okay, Mads, look, thanks for the update. And don't forget, for by-the-minute insights on the global markets, you can visit tradingfloor.com, and you can also follow us on Twitter at tradingfloor.com. Thank you, and we'll see you next time.